It's Natasha McPherson, Managing Director of Hall Wealth Management with insights for the year 2024. As we stand at the threshold of a new financial landscape, uncertainties and opportunity intertwine. In this video, I'm going to unravel the key trends, potential challenges, and exciting prospects that we anticipate for the upcoming year. We'll be going on a quick journey through the economic forecasts, investment strategies, emerging market dynamics, and more that are poised to shape your financial journey. Whether you're a seasoned investor or you're just embarking on your wealth adventure, our mission is to empower you with the knowledge needed to make informed decisions. And that's exactly what I'm going to do. So let's get started. Let's start with the economy, which is expected to slow down. We believe a recession is likely to emerge in 2024 as consumers under increasing debt burdens deplete their excess savings and are no longer able to keep up with debt payments. Leading indicators that we're watching include an increase in serious delinquency in credit cards and auto loans. We expect the spending splurge to end, with consumers reverting the trend. In 2024, the consumer will no longer be willing to spend as they did in 2023. We expect to see a Federal Reserve focus less on inflation and more on the other part of their dual mandate, which is stable growth. As already highlighted, inflation will still hover above the 2% long-run target and remain a concern, but the Fed will likely be less laser-focused, given that the trajectory is going in the right direction. When it comes to the job market, some call the recent shift in favor of the average worker an adjustment of the workforce, considering that workers have rarely had this much bargaining power. As the American worker has had a few years to adjust to the hybrid work model, we should continue to see a fair amount of turnover. Some have seen the fastest way to higher paying is moving to a new job. Of course, the hybrid model can only operate in some sectors, so it impacts varies depending on the industry. I quickly just wanted to add this in the deck. That way you could see the forecast for economic growth and consumer inflation across regions in 2024. Now I'm going to dive into stocks for 2024. As the next 12 months of the bull gets underway, market history tells us solid gains may lie ahead. Of the 12 such periods since 1950, the S&P 500 has gained an average of 12.6% and was positive every time. A gain of this magnitude seems reasonable given the potential for support from the Fed as inflation falls. Inflation is still elevated at this time. High rates remain a threat to the economy and the stock market. Stocks and bond yields became increasingly negatively correlated, which means moving in opposite directions in 2023. While that wasn't great news for the stock market, it does mean interest rates could present an opportunity, as we believe the 10-year Treasury yield could be less volatile in 2024. Our 2024 S&P 500 earnings per share forecast is $235 per share, which is up from our prior estimate of $230. The new estimate represents only about 7% earnings growth from the current 2023 consensus S&P 500 earnings per share estimate of $219. Beyond economic growth, how companies manage weighing pricing power as inflation falls is key to earnings outlook. Reversals of the 2023 declines by the healthcare and natural resource sectors, along with increased earnings growth in the technology sector, will help drive a turnaround in overall earnings. You might be thinking, what exactly does that mean? So, in simple terms, right now stocks are considered quite expensive. One way to measure this is by looking at the price to earnings ratio, which is a PE, which is higher than the usual average. This ratio compares the stock price to the earnings it's expected to make in the next year. To really understand if stocks are a good deal, we also need to think about interest rates and how much money you can make from bonds, kind of like loans to the government when we compare how much profit you could get from stocks, which is earnings divided by price, to what you could get from bonds, specifically the 10-year Treasury bonds. We find that stocks don't seem to offer much more than bonds. This suggests that investing in stocks might not be a significantly better deal than investing in bonds right now. So, in simple terms, stocks might be fully valued, meaning they're not a bargain at the moment. While earnings growth will likely help push stocks higher in 2024, the contribution from valuations may be more limited. Stocks appreciate in value primarily in two ways. Either earnings grow or valuations become richer. The good news is that stocks will move higher in the coming year without much help from valuations. A different story from the past 2 years. A price to earnings ratio of 19.5, in line with the 5-year average, represents only a slight improvement in valuations from the 18.8 level in mid-November. Our projected 2025 S&P 500 earnings per share of $250, we estimate a fair value range for the S&P 500 at the end of 2024 to be between 48.50 and 49.50. This suggests potential high single-digit gains at the midpoint. We're going to head into bonds now and the potential of them getting back to normal. With the economic data so far continuing to reflect a more resilient economy than originally expected, we think Treasury yields are likely going to stay higher for longer as well. As such, we think the 10-year Treasury yield could stay in the 3.75% and 4.25% range with risks roughly balanced. However, while we think the economic data softens in 2024, we should allow the Fed to gradually adjust monetary policy lower. We can't entirely rule out two other scenarios either, though: traditional recession or a re-accelerating economic environment. You may be thinking, Natasha, how much higher could rates go? Well, looking at interest rates over a longer time horizon provides a bit more clarity on what could be considered normal for interest rates. What you see here is data since 1880. It shows that interest rates were in a fairly tight range before the spike in interest rates that took the 10-year Treasury yield to those very lofty levels in the 1980s. In fact, long-term rates mostly traded within the 3 to 5% range for nearly a century before moving aggressively higher as the Fed fought those generationally high inflationary pressures. Periods outside of that 3 to 5 range have resulted from the economy's growth and inflation dynamics, which ultimately shapes the Fed's interest rate policy. So, the sharp increase in the 10-year yield over the past few years puts the yield firmly back into the normal, historical range. Corporate downgrades are outpacing upgrades this year. The corporate credit markets have been resilient so far this cycle, with credit spreads or the additional compensation for owning risky debt remaining below historical averages. However, with the increase in Treasury yields over the past few years, corporate interest payments are set to increase as well. And while the health of the corporate landscape is generally positive, rating agencies are starting to adjust their outlooks based upon, among other things, the expected increase in debt payments. The ratings environment remains relatively calm for companies across investment grade. However, lower rated companies have taken the brunt of downgrades and will likely to continue to in the upcoming quarters. Year to date, the S&P has downgraded its outlook and the outright rating on 814 companies, both investment grade and high yield, versus only 512 upgrades, which makes 2023 already the worst year for downgrades since 2020. Now seems like a good time to get in the increasingly complicated landscape of geopolitics. Commodity prices have been easing lower as the global economic landscape, particularly as China's slowing economic recovery continues to soften. The dollar is stronger compared to foreign currencies because of favorable interest rates, but is overvalued compared to the yen, euro, and British pound. I'm going to summarize a couple things here. Capital is flowing back to the US accordingly. The yen here, if you take a look, is the weakest because the Bank of Japan hasn't acted. The United States dollar is clearly very expensive on a historical and relative basis, and there's going to be a value in holding foreign denominated assets in the longer term. And it will make sense soon to own foreign assets on an unhedged basis. But until we see a persistent shift towards synchronized global growth and central bank tightening, which isn't US led, foreign currency as a whole will likely struggle to meaningfully outpace the dollar. Now I'm going to move into alternative investments a bit. We do expect greater dispersion and volatility brought by the continued decoupling of global economy and policy actions, well-anticipated slowdown in economic activities, and the rise in geopolitical risk, as well as the political events like the presidential election. Among private market strategies, we expect private credit and infrastructure to continue to show their resilience as both strategies have secular tailwind at play. We are positive on secondary markets as well. Bigger market share and attractive yields is when it comes to private credit. We recommend staying in high quality assets as we cautiously monitor the pickup in distressed and default rates. One of the key areas that we see continue to benefit from the secular trend of global digitalization, decarbonization efforts, and the Build Back Better Act in the US is infrastructure. And when it comes to secondary markets, they lend compelling opportunities for managers, general partners, and limited partners turning to secondary markets to meet their liquidity needs and take on assets at an attractive valuation. Well, this brings us to the end of our outlook for 2024, and I want to express my gratitude for our journey so far, as well as the journey we're going to have this year. And I also really appreciate your curiosity and engagement in this. And I want to let you know, no matter what, the future holds boundless possibilities, and I'm eager to continue this conversation with you because I'm sure that you have questions. So please don't hesitate to reach out with me with any questions or thoughts that you have. I love connecting with you, and I'm looking forward to the year ahead. Take care, and thank you so much for watching this.